It's late at night. You're lying in bed and can't fall asleep. All you can think about is how much credit card debt you have, or how are you going to survive in retirement? How are you going to pay for your child's college tuition? But what if I told you it's never too late to start crushing debt and to start investing for your future? In this video, I'm going to be going over how to start investing in 2025 and answering the why, the what, the when, and the how. And if you make it to the very end, I have 2 bonus tips for you to start crushing debt and start investing for your future. So let's dive right in on how to start investing in 2025. Question 1, why invest? The reason for that is you want to start planning for the future, but more than that, there's a concept called inflation, where savings alone won't cut it anymore. And inflation can basically be explained by the price that you pay is not going to be the same price a year from now, 5 years from now, from 10 years from now. So you want to be able to start investing rather than savings so that you can beat inflation. For example, if you're going to Starbucks and you're spending $5 on coffee, that same cup of coffee today might be $5, but in a year from now, 5 years from now, 10 years from now, it's not going to be $5. It's probably going to be $8 or $10. So you want to be ready and not just hold on to your money and save it, but you want to invest your money so you outpace inflation. So what is the smarter move? You want to invest that money to grow it, not lose it, right? Because if it's sitting in a savings account, you're just losing to inflation. So here's how it works. There's something called compound interest, right? When you're investing, what that is your money makes money, and that money makes even more money. And it's the snowball effect. Albert Einstein famously said, compound interest is the 8th wonder of the world. He who understands it, earns it. He who doesn't, pays it, right? Albert Einstein even knew the power of compound interest and the power of investing on a regular basis so that you can outpace inflation. For example, let's say we begin investing $500 per month. Okay, so that's $6,000 per year. And $500 per month, we can find that in some expenses, whether it's eating out less or buying less snacks at the grocery store, or even that expensive hobby, cutting back a little bit on there. We can save $500 per month. And with a conservative 8 to 10% return, what does that look like in 10 years, 20 years, 30 years, 40 years? In 10 years, that $500 a month of savings is going to be over $100,000. In 20 years, it's going to be over $380,000. In 30 years, it's over $1 million. And if you save consistently $500 per month with an 8 to 10% return, then you're going to be at 40 years over $3 million ready for retirement. That's why starting early or now is everything. So you want to start early. So let me know in the comments. I really want to know, what is stopping you from investing today? Is it credit card debt? Is it student loans? What is it that's stopping you? I really want to hear from. So please leave a comment in the section below. Part 2 is what to invest in. If you're new to investing, skip the hype. That's all I want to say is we don't want to follow the hype. Don't chase speculation, but let's focus on time-tested and proven investments. The best beginner move by far is investing in something called index funds. Once again, the best move by far is to invest in something called index funds. Instead of buying one stock with an index fund, you're buying a basket of hundreds, okay? That means less stress, lower risk, and better long-term growth, okay? So you're really spreading out that risk. So instead of putting all your eggs in one basket with one stock, one company, you're buying a fund, an index fund, which has hundreds of some of the largest companies in the world. For example, a really popular index fund is the S&P 500, and I personally invest in this as well. This fund includes top US companies like Apple, Microsoft, Nvidia, Home Depot, and hundreds of more. Warren Buffett himself says most people should just buy the S&P 500. One of the wealthiest person in the world, Warren Buffett, also recommends index funds like the S&P 500. Jack Bogle, the founder of Vanguard, said Don't look for the needle in the haystack, but just buy the whole haystack. He mentioned that, right? You don't want to just buy one or find that one. Speculation, right? What's hot today won't be hot tomorrow, right? So you don't want to follow those trends. Once again, what to invest in? I highly recommend index funds, right? It's due to its simplicity and your ability to set it and forget it and spread the risk, okay? Because each dollar that we all have is very precious. We want to begin preparing for retirement, paying for the college tuition for our children. So what do? We want to invest in something conservative, not something that's based on hype. When and how much to invest? This is another very important question that we have to answer. So the first part is, when should you start investing? And there's two questions or two checklist items that I definitely recommend for you to think about in your own situation. And the first one is, do you have high interest debt, like credit card debt, which is on average in the upper 20s? If you have that, you are not yet ready to invest. Pay off the credit cards first, and then you may be ready to invest. The second checklist item that after you're paying off high interest debt is, do you have an emergency fund? And if you refer back to my previous video on 5 money habits keeping you poor, I go over what an emergency fund is. And basically, an emergency fund is exactly what it says. It's for emergencies, to have enough cash on hand so that you can pay for the HVAC going out, or a car repair, or something happens medically, right? You want to have some funds available for those emergencies. And what I typically recommend is between 3 and 6 months of an emergency fund. So making sure you paid off high interest debt, have an emergency fund between 3 and 6 months, then you're ready to start investing, right? Once those boxes are checked. And if you don't have those, we want to crush the debt, high interest debt, as well as build that emergency fund first. When it comes to investing, you might be thinking to yourself, I don't have enough money. But a lot of investing platforms allow you to start with just $1, right? The minimums are very low. So whether it's $1, $100, $500 per month, let's start somewhere, right? Because we want to start planning for that future and be ready. And when you're investing, the big mindset that we want to make sure that we all have is that we're looking long-term. And long-term is greater than 5 years, greater than 10 years. How much can you invest today or each and every month consistently so that you don't need to touch that money? Okay, we want to be able to come up with a consistent plan. It might be $100, $500, $1,000 per month. And the best place to look for that is those extraneous expenses, whether it's eating out, whether it is shopping, whether it's canceling some streaming services that you don't really use or watch on a regular basis. There are expenses. There's always holes in the bucket of our spending. So you want to take a look at that. Some good brokerage firms, right? How do we invest? You want to utilize the most reputable brokerage firms. And I recommend 3, either Fidelity, Vanguard, or Charles Schwab. Please note, I am not sponsored by them by any means, but these are the platforms that are the most reputable and the largest. Okay, so we want to use reputable investment online brokerage firms. I also have 2 bonus tips for you. So we're not done just yet, but if you've made it this far, thank you so much. I have some more information to share with you. First bonus tip is, we want to make sure we have a long-term strategy and avoid mistakes. So rule number 1, think long-term. Like I said, greater than 5 years, 10 years, ideally longer, right? Because we're looking for turning that $500 per month to $3 million, right? So that's going to be 40 years, right? We're looking really long-term. Even if you're starting in your 30s or 40s, with life expectancy continuously going up due to modern medicine, at 40 years, you're probably still capable of working in your 70s or 80s or possibly 90s, God willing, right? So we want to make sure that we're starting today. Second thing is, we want to ignore the day-to-day noise. When the market drops, don't panic and sell. Stay steady. And the famous Bible verse, Ecclesiastes 1:9, and that states, nothing new under the sun. So the noise that we hear every single day, whether it be political, that's noise, right? We want to stay the course, stay consistent. Ignore that, because there's nothing new under the sun here. So ignore the noise. Automate your monthly contributions and forget about it. Pay yourself first. Refer back to one of my previous videos on 5 money mistakes keeping you poor. paying yourself first is vital, right? So paying your first means savings, adding to investments, things like that. And you want to always be patient, stay consistent, and trust the process. And the last bonus tip is something called fast lane investing, right? This is something that can really expedite your investment. And what this is a little bit out of the box thinking here. So how do we grow our wealth even faster? And I have some suggestions here that I myself personally are applying. Consider investing in yourself or your own business. Okay, this is called fast lane investing. Consider investing in yourself or your own business. So for example, what does that look like? Maybe taking a course or earning an extra certification that will boost your income, right? What are some further education opportunities that can really help your career currently or open different opportunities so you can boost your income? Another one is starting a side hustle or even a YouTube channel, right? Start thinking about that. Or lastly, building your own product or service, right? The US is filled with millions of entrepreneurs, right? Sprouting up every single day. You want to maybe think about what is a product or service that you've been thinking about late at night, during the daytime that you want to start, right? Really look into investing in that. Fast lane investing. The returns from investing in yourself can be 10x, which is going to be better than any index fund stock out there, right? So you want to make sure you are thinking about investing in yourself, fast lane investing. And to really recap all of this, why invest? We want to invest early and consistently so we can help beat inflation. Let's just not save, let's invest. What can we invest in? Purchase index funds. Let's stay conservative, stay the course. When should you do this? Once you've eliminated high interest debt and built an emergency fund. How to do this? Start with reputable online brokerage firms like Fidelity, Vanguard, Charles Schwab. Remember to think long-term, not the quick wins. Forget about the noise that you hear day to day. Stay the course. And then consider investing in yourself, that fast lane investing that I just talked about. Thank you so much for making it this far. And if you want more content like this, please remember to subscribe to the channel, and I hope to see you next time. Bye.